Jonathan, welcome to India. Always a pleasure to cover, the Morgan Stanley conference. This is Nikunj Dalmia from the Mumbai studio. Jonathan, your house view on India has been bullish of late, and you continue to support that bullish house view. But as a house, are you not mindful of all the hum and drum which is happening in the world market?
Well, we like India versus the rest of global equities, and we're bullish equities globally. So yes, there's always going to be political developments, sort of noise in the economic data, but the big picture story is that we're going through the best period of economic expansion globally that we've seen since 2006-07. We think globally earnings are going to be up mid-teens growth rate for the broad global equity indices this year, and another single-digit year-on-year earnings growth for global equities next year. So that's the best back-to-back earnings growth environment we've had since 2006-07.
So at the market top right now at 9,700, or peak I should say, are you not a little worried that maybe the markets are getting a little bit stretched and the valuations are getting a little bit toppish?
Well, when we look at valuations globally, if you look at metrics like price to book, forward P, dividend yield, they're at the 50th percentile or somewhat cheaper. The valuations that are more stretched globally are metrics like EV/EBIT, EV/EBITDA. Our Sensex target is 34,000, and that's assuming 16.5 times forward earnings to June 2018, and 16.5 forward P for Sensex compares with a valuation assumption that we have for the S&P of about 19 times. And about 15 times, for example, for Japan. So it's very much in line with what we're thinking for equities globally. And obviously here we're at the middle of an earnings upswing in India, similar to what we talked about globally. So the short answer to your question is no, we're still bullish on equities globally and in India.
What gives you the confidence that in India, we are on a cusp of an earnings recovery? Jonathan, frankly, we've been waiting for this economic recovery for many years now. And unfortunately, we've not seen that hope turn into reality.
Well, if you look at earnings, we've had a number of one-offs that affected the commodity-related sectors, and some of the companies in India that have made overseas acquisitions, some of those had to take write-offs. But when we actually look at the forward earnings expectation we have over the next 12 months, it's 18% from my colleague Ridham for India. And if you look at ROE and how that's beginning to pick up, you're really quite close to a situation now where many of the large sectors in India can kind of fire simultaneously. So the sector overweights we have are consumer discretionary. We're looking at the pickup in two-wheeler sales. We like IT, which is interesting because that's a sector that had some challenges, but with the improvements in the global economy, that should also do quite well. And the financial sector, where you were just covering the interest rate situation on your prior segment, you look at the decline you've had in 10-year bond yields. You were at the beginning of a loan growth cycle again here, which should help the financials in India. And then we're sourcing those overweights from being underweight sectors like utilities and consumer staples, which are somewhat, in the case of staples, somewhat expensive and with more challenging competitive environments than some of the sectors we like. And then one globally facing sector, healthcare, which we are more cautious on than the IT names in relation to some of the regulatory pressure on the generic pharma producers. So we're trying to pick our spots within the Indian market. Not all of the sectors are reasonably valued, and not all of the sectors have decent earnings growth outlook, but the ones that we have talked about just now, consumer discretionary, IT and financials, that's where we really want to have at the core of the portfolio.
What, according to you, would be the risk to this price target of 34,000 that you've put on the Sensex? And considering you talked about the fact that globally as well the rise is tiding, would you say that one needs to monitor the global developments at this juncture, and if indeed there is to be a pause, it is indeed going to be led by global parameters or global cues for that matter?
Yeah, so you should always try and think about what the risks are. If you're positive, like we are, you need to think about why you might be wrong. So let me give you a few reasons we might be wrong. One, which is particularly relevant to India, would be if the oil price picks up in a major manner. That's always been a challenge for India in relation to inflation in the current account. At the moment, oil is very well behaved. It's sort of flat to downish for the year to date. Another one would be around the longer dated bond yields in the US and how aggressive the Fed is on its hiking path and how the hiking intersects with actually starting to reduce the size of the Fed's balance sheet. Now, we think the 10-year bond yield in the US is constrained and won't go much above 2.4% this year. It's down at 2.2 right now. But if you do get that kind of increase in the core cost of capital, let's say the 10-year yield were to go towards 3% because there's an inflation breakout in the US, then that's always been a challenge for emerging countries, and that would limit the ability of India to engage in more interest rate reduction. It would mean that the decline we've seen in the 10-year bond yield in India would not continue if US core yields went up. And again, part of what you've seen in India this year is very significant moves into equities by local investors on sort of bond yield versus earnings yield considerations. So those are some of the risks that might undermine what's otherwise a very bullish story around earnings.
When the new administration or when the Republican administration took over in US, the general view was that Donald Trump will unleash a lot of pro-market reforms. As of now, we've not seen and we've not heard anything which could be called as pragmatic or anything which could be called as path-breaking. How come that is not making US markets nervous, and how come that is not having an impact on the global equity construct?
Well, I think there's two ways that reform is undertaken. One is by overt legislation, and you're right in that sense the healthcare reform's not been legislated. We still think the tax reform will ultimately go ahead, a big reduction in corporate and income tax, personal income tax rates for early next year. But then there's also regulatory reform, which is much more micro and much more in the remit of individual agency heads and department heads, and that is happening in quite a major way. One of the reasons we're bullish on financials actually in the US is regulatory reform in terms of reducing some of the pressure that's been felt on the financials from regulation. We've obviously seen, this is highly controversial, the President's own decision in relation to the climate change treaty. And that's an example of where you've got executive action, but you don't actually have a legislative requirement. So there are things happening in the US.
So are you making a case that it's time to really move out of this so-called Trump trade and focus on the global growth trade? I mean, we may have seen a strong rally in beginning of the year and end of last year because of Donald Trump. But is that rally history now? Is it time to move on?
Yes, I think the Trump trade idea was frankly more something that was prevalent in the media rather than in, I think, the investment community. The investment community was very focused as far back as Q1 2016 on the troughing in economic activity in China, and then really a synchronized global upswing in activity, particularly a strengthening of data in Europe to the best we've seen in almost 2 decades that was ongoing in the third quarter. That then coincided with the US election outcome, but the global economy already in the third quarter last year was exhibiting this very strong growth that we began this interview talking about, the best synchronized upswing in global economic activity since 2006-07. So for example, if you look at export data from Korea or Taiwan, and more recently, in fact, across the board in Asia, including India, the pickup in exports was going on from the third quarter onwards. And now we're moving on to a phase, we think, where that segues towards private capex spending. So it's really a global synchronized acceleration that's driving stock markets. It's not a Trump trade.
I just wanted to, get your thoughts on this entire global setup. So back to India, and that's what I think the agenda of the conference is, and that's what, our viewers would like to understand from you. Now, if I look at 2 broad pillars for India, one side you've got consumption and the other side you've got, capex stroke investment. Your house view of late has been that you are betting on the investment revival and not so much so on the consumption revival. So when you're bullish on the investment stroke, the capex revival, what is the best way to participate in that?
Well, we like, on our side, we like consumer discretionary, as I mentioned earlier. We also do like investment spending plays where they're capable of being implemented in the portfolio. But what you've seen so far is that government spending mix has shifted away from salary expenditure, what we call current government expenditure, towards capex, which is good. And we've already been hearing at this conference actually this morning about improvements in inward FDI from many countries, including Asian countries, into India to take advantage of the natural growth opportunities. So yeah, we like both the consumption and the infrastructure investment story in India. And the next phase is, the final phase is probably going to be private capex spending. And at that point, particularly the real estate sector in India may come back into favour. And that's something, again, we haven't really seen since 2006-07. And the real estate sector obviously should be affected by the ongoing urbanisation. We've already been hearing about that at this conference, and household formation. So there are two major growth drivers on the domestic side here in India, both consumption and investment.
Yeah, and to add to that, Jonathan, the policy setup as well seems pretty firm right now, and the government determined now to launch the goods and services tax rollout as well and implementation by July 1st. Tell us a little bit more about how you're sussing the policy environment and how committed and dedicated the government has been to drive this process higher.
Well, I've covered India for almost 25 years, and the GST is a major step forward, a really key way of tying India together economically. The other thing that you're seeing, as I just touched on just now, is that the government's fiscal stance is very much improved, both the overall size of the deficit and the composition of government spending. And that's played a major role in the reduction in inflation that we've seen, and that in turn has allowed interest rates to be on this very nicely declining path, which helps the financial sector, and it helps, I guess, the development of the economy overall when you have lower nominal interest rates and a more stable real interest rate environment. The current account position has also improved, and India's exports are actually in a structurally better position than we've seen before. So there's quite deep macro improvements here which underpin quite a lot of our bullishness, and I think our global clients recognize that. And so it's very nice to see this overweight on India that we've had has worked very well this year. We've had a very strong market, and we think there's more to come.
The general sense which I get when I speak to my friends and some of my colleagues both in United States and US is that a lot of money which is coming to emerging markets is not country dedicated money. This is just global broad allocation which is coming via the ETF route. Would you buy this thesis?
Yes, that's common worldwide. People tend to buy ETFs these days, and the ETFs they buy tend not to be single country ETFs. They're more, say, Pan-Asia or global in nature. But India has a high weight in those, and then that's probably about 70% of the money. The other 30% is still active money, and that's obviously what can pay particular attention to country allocation or stock allocation, and that's where we're very much seeing this pickup in interest in India. And so that's the overweight part of their portfolio.
Jonathan, this time are you convinced that for banks the NPA situation is resolved when banks, after the new bankruptcy laws and after the new NPA norms, would be able to recover a lot of their bad loans?
So you've had pretty good disclosure of the bad loan situation in India over several sort of waves of recognition. It's not by any means a perfect situation, and some of the banks do still need new capital. But what you are seeing now is a turn in the economic cycle, which should allow new loan growth to be made on a better footing than some of the legacy loans that have got into trouble. And that dilutes, frankly, the problem for some of the banks, allows them to grow their way out of the problem. And with interest rates, as I was mentioning earlier, again, quite range-bound, if not down, that makes debt service more easy for problematic borrowers. So obviously there was lending that was made, particularly in the prior boom period that we exited in the GFC, that has gone bad. But I think India's done a better than average job in an EM context of recognizing the situation. And that allows some of the better banks to move forward.
So aside of the sectors and stocks that we've already highlighted, tell us where else do you see value on the table right now, Jonathan? Because the two legs of the market, that's IT and pharma, have been stark underperformance. Very varied reasons why these sectors have been laggards. But do you think that the underperforming leg of the market as well will now begin to participate, as one has already seen dots of green are already emerging within the pharma pack?
Yeah, so we've distinguished between IT and pharma broadly speaking, and the IT, both of them, as you rightly mentioned, have encountered sort of idiosyncratic difficulties around their business models. One challenge for the IT sector has been, frankly, the Trump administration and some of its agenda. But that shouldn't take away from the bigger picture issue of the growth of e-commerce, the continued growth of the cloud, of security spending by major corporations, IT security spending. That's been highlighted by the recent ransomware attack. And I think what you need, it's clear that the Indian IT service providers have a major role globally to play in that sector. It's just our judgment call when you look at where they're valued, which is obviously moving down to lower multiples, that sector is more interesting to accumulate as a contrarian sector than the pharma sector that you touch on. And then we have obviously the core of the portfolio being the financials, consumer discretionary and infrastructure plays.
So, I've read a report from your house a couple of years ago, and I think me and Rhythm had a chat around it, and it was some brilliant analysis by your team which talked about that how every time US markets have gone higher, it has translated into better opportunity for Indian IT sector. But this time around, is it different? I mean, is the nature of the business changing so dramatically that the economic recovery in US may not translate into good work and better business for IT companies? Is that a reasonable threat?
Well, we mentioned some of the challenges posed in investors' minds by the Trump administration around the visas, amongst other things. But actually, US isn't the only market for IT services spending. The Indian firms have substantial competitive advantage, and we feel it's overly discounted in the stocks here. So, yes, we actually think that's the sector that you should be looking at on a contrarian basis going forward.
So, Jonathan, let me get closing comments from you. After this interview or after the conference, if a client walks up to you and he says, Jonathan, I've missed on this India story. My bad, I've missed on it. Here's my $10 million. Please help me to allocate. I can digest a 15% volatility. I can digest a 10% downside, but I'm looking at absolute returns. What would you advise to that client?
Well, to buy India with a target of the Sensex 34,000. So to buy India ETF if you have access to a country ETF, or to make sure you buy an emerging market product that has a high India weighting in it, and to adopt the sector skew that we talked about in the earlier remarks on the interview. We are bullish on the market. It's not the only market we're bullish on. We also like China and Japan. We're very cautious, though, on Australia, which has had a very poor outcome for returns this year, and for the EM investor for South Africa. So I don't want your viewers to go away with the idea that we're bullish every market. We try and pick our spots, and the macro story here and the micro story is better than the average EM and substantially better than the underweight markets we have.
Something, Jonathan, you may not be able to put it in a report, but something I'm sure you've tracked in your last 25 years of you've tracked India. What does this current leg of bull market remind you? Does this remind you of 2006 or 7 when the bull market was live and young? Or this is now a bull market which is like 2007 and 8, where the bull market was on, but the bull market was getting tired in terms of valuations and run up?
I don't think it's as extreme an environment as 2006-7. The global synchronized recovery then ultimately led to a major overshoot of commodity prices. We're not seeing that right now. So that's different. And if you look at the sort of excesses in relation to investor behavior, and particularly in certain segments of the market, we're not in such an extreme environment. If there is a parallel, it's more like late 2005 into early 2006. And we don't know exactly how the cycle will come to an end, but all cycles finish ultimately. We actually think you should be watching the US more than the rest of the world in relation to cycle risks. And the risks are more around what we touched on earlier in the interview, how aggressive is Fed policy and how much do US interest rates go up this cycle? And does that uncover problems in relation to debt service inside the US economy? So if you look back, most cycles actually end in the US. It was subprime that was the trigger for the end of the cycle in 2007-8. And before that, it was issues around LBOs and excessive spending in sectors like fiber optics in 01-02, and you can go back to savings and loan, etc. So it's really, the risk is, if it is out there, is probably for late 2018. It's certainly not the second half 2017 risk, and it's very unlikely to come from within the emerging markets. What would actually cause this cycle to get into difficulties?
Jonathan, such a pleasure speaking with you. Thank you so much for taking the time out, and you have a good conference and a good stay in India.
Thank you.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/ETNow.